Hey everyone, thanks for coming. My name is Kefi. I handle crypto and blockchain side of things at SBI, a TradFi conglomerate in Japan. Before we get started, I wanted to just thank the organizer and as well as the affiliate partners putting together this event. I know the team has been working tremendously hard to make this happen, so thank you again. Now, to get started, as I introduce myself, my name is Kefe. I'll hand it off to Jerry and then Andy, Ryan, and Danger to introduce themselves. Take it away, Jerry.
Thank you. I thought you were going to do for us. Okay, my name is Jerry. I actually worked in some bank for 25 years, and last year I decided to leave the banking industry and jump into DeFi because I found something that is important, which is missing in DeFi space. So I established the company about a year and a half ago, and right now I have a team putting our DeFi protocol on testnet. So we'll let you know what we're doing later. Thank you.
Yeah. Hi guys, my name is Andy. So I work at Frax Finance, and we basically do stablecoins. We issue 3 different types of stablecoins. One's pegged to the US dollar called Frax, one pegged to the Ethereum, Frax Ether, and then one pegged to flat coins, which is the US CPI called FPI. And we have governance tokens around it and build sub protocols to kind of support the stablecoins. Yeah.
Hi everyone, I'm Ryan. So I lead APAC partnerships for Offchain Labs. Offchain Labs is the initial builder of the leading layer 2 Arbitrum. So I work closely with teams that are building on the Arbitrum public chains, as well as those who are thinking of spinning up their own app chain using the Arbitrum Orbit tech stack.
Hey everyone, my name is Danger. I am a DeFi trader and also a researcher. So started doing DeFi in 2019, and when 2020 DeFi summer came around, I was making more money doing DeFi than my job, so I quit, started doing DeFi full time. Been doing that ever since. And then I have a research team. Today in DeFi, we publish a newsletter, so if you want to do airdrops, farming, all the alpha's there. Yeah.
Okay, so thank you. Today's conversation is about the future of DeFi, but before we get started onto some of the bread and butter of this topic, let's zoom out a little bit to see the big picture, right? Remember when Uniswap first came out at the end of 2018, with kicking off the whole new chapter with its revolutionary AMM model, and then we've seen a bunch of innovative products like synthetics, Curve, Compound Up, and of course Frax, popping up one after the other. And fast forward to today, where we've been ridden the the roller coaster through DeFi summer and winter, and with all the buzz around LS DeFi right now, it feels like we might be on the way to next DeFi spring. Maybe start with you, Danger. You are like a walking DeFi encyclopedia. Could you give us a snapshot of where we stand in the DeFi landscape today?
Yeah, absolutely. So I started in DeFi in 2019, which is relatively early. So that was when Compound Finance was coming out. That was the first peer-to-pool lending protocol. And then Curve came out. Uniswap was already out and started growing a lot. And compared to then, it's like totally different. Like back then, we celebrated having $1 billion TVL, and now it's like $55 billion. So it's like 55x. It's grown massively. And back then, the industry as a whole was very immature. We had these nice protocols like Compound, but the number of active traders and people who understood it was super small. So I think at the time, I was like one of the top 10 people in the world who understood DeFi in 2020, early 2020. But now there's thousands of people doing this. It used to just be, I used to feel like the smartest person in the room, and now I'm probably the dumbest or something. All the Harvard people came, the Stanford people came. But the good thing is now the projects are much better. So we had 2020, we had Sushi Swap, we were farming sweet potatoes and kimchi, these forks, and now we have Frax Finance doing BAM, we have Term Structure doing fixed rate lending. We have a much more advanced ecosystem and also much more advanced players. So yeah, I think it's definitely DeFi spring now.
Ryan.
So I could share more about the DeFi ecosystem on Arbitrum. Right now, we have one of the largest layer 2 TVL of about 8 billion. So that represents about 52% of the overall L2 space. In terms of ETH liquidity as well, we have over 1.2 million ETH that is currently bridged onto Arbitrum, with the bulk of it being ETH as well as stablecoin liquidity, so 1.8 billion. We have seen a variety of use cases. So we have seen teams building perps, money market protocols, and there are also a number of stablecoin issuers that are launching natively onto Arbitrum. I think that's very interesting. And another point I want to note is we see institutions coming onto Arbitrum, with the likes of Franklin Templeton, who launched their US money market fund on Arbitrum, and also Kinto, a team building layer 2 using the Arbitrum Orbit stack. It's a permission DeFi protocol that focus on getting more institutional capital in. So KYC, CFT, or AML, all is done on-chain with Kinto.
Yeah, for me, I think I can comment about a bit on stablecoins. I think back in, I guess 2 years ago, it was more so about keeping the peg that was very important, and today it still is. But I think we've seen the fall and rise of different stablecoins, and there's great stablecoin projects, and I think everyone kind of learned from each other, basically on stablecoin, like the stability mechanism. But also, I think these different stablecoin projects kind of expand their vision beyond just keeping the peg. It's more about having different types of mechanisms and sub protocols that kind of support your stable coins. And we see a lot of stable coins going out into the world of like LSDs. So I think it's just really expanding on how stablecoin issuers or stablecoin protocols really expand. And I think it's kind of proven that it's here to stay. It's just about how you can expand into other different like RWAs and touch upon other topics to kind of improve.
When you talk about market maturity, right? What immediately come into the TradFi mind is the financial infrastructure and the capital market efficiency. So if we talk about the capital market efficiency, simply we can compare the US dollar market versus emerging markets. So then you know what is mature market, what is like less mature market. And then in terms of the capital market efficiency, where the currency price or the interest rate of that particular currency, or in terms of the volatility or the financing availability, it's totally different. So if you think of the debt financial market, there are three pillars supporting this whole market. That is money market, that is foreign exchange, and the fixed income market. And then the biggest gap is fixed income. If you can think of that, the fixed income is basically the fundamental infrastructure to keep all the emerging markets becoming like a more matured when there is a chance for the whole country's balance sheet, including the institutions and the corporates or even individuals, to manage their balance sheet to match the duration of their asset and liability. Right. So I think when we talk about the maturity of the market, it's very clear. DeFi is worse than the any emerging market country. That is where we are today. And in terms of the institutional adoption, that is very clear, right? So if you see, it's very easy to compare where you see the most of institutional investment. That will be the first priority will be going into developed country, and then those EM country, right? So I think that's very clear for anyone if we can take a look at this comparison.
Yeah, so moving on to our next point of discussion, I'm curious to hear about what are the unsolved problems and opportunities that you all see in the DeFi space right now. For instance, right, the proliferation of L2s, L3, and app chains has clearly led to some issues around liquidity fragmentation, right? And with the rolled out, like term structures, ZK rolled up, ZK true up, and then Frax chain, right? And Arbitrum ordered L3. Like, what's your view on this, and how do you see that playing out? Maybe from Jerry.
For the issues in DeFi, what we see is that there is no interest rate curve. There's no benchmark. So that when you take a deep breath and thinking about tomorrow when you wake up, the US dollar fixed income market is gone. The where do you price the rest of like 80%, 90% of financial instruments? You don't know, right? The overall, the financial industry will collapse. And today, in DeFi, we are actually in that situation, but we are not aware. And then when I look back, I'm relatively new to DeFi space. The reason why is when I see all my ex-colleagues or some like TradFi guys jumping into DeFi, but I don't see many fixed income traders or somebody want to put effort into fixed income. It's very difficult. And so that's why when I thinking deeper on this automatic market making process and thinking deeper into the peer-to-pool model of like a RWA compound that they very successful, I found that it's not applicable to fixed income. So that's why we needed to build something new. We needed to bring up the auction process for primary markets for the fixed interest rate borrowing lending, and then we need to bring up this the real-time order book for the fixed income token trading as a DEX. So this is totally new. So that's why we have to come out with a new infrastructure, which we haven't seen in the market. So this is what we are trying to solve, and this is the issue we see.
Indeed.
Yeah, I think one issue that we had was probably has to do with bridging. Within this year alone, I think we saw a lot of bridges collapse and them being hacked. Malicious exploits. So what we did at Frax was we developed our own ferry system called Frax Ferry. Uh, the design is that it does take a longer time to bridge over your token or Frax assets, but the idea is that it's more secure. So we value security over the time spent. So that's why we pulled all our liquidity from third-party bridges, and we developed our own Frax Ferry. And then one big issue, I guess, in DeFi in terms of my personal experience is the educational part of it. I think in anything, I think education is the toughest hurdle to kind of go over, especially specifically because I'm based in Korea. I think a lot of Asian countries, specifically, I think in Korea, the educational part of DeFi it really lacks, and it's up to people like us and people in the space to kind of build that educational system so that people know more about it and onboard and scale up the entire space in general.
So for me, I can talk a bit more about how DeFi teams should be thinking about, building on a public chain versus your own application-specific chain. So a few considerations is block space. So are you competing for block space with, other protocols on the public chain? Do you need, like, for example, custom gas fee token, the ability to modify the underlying tech stack to meet your needs? So, pushing the TPS of your app chain to meet certain standards so that there's a great user experience. Beyond that, also it's important to consider about block times. So whether the tech stack you're using has fixed or variable block times. With fixed block time, essentially, teams that are building on these app chains will run up very high fixed costs over the course of a year, even if there aren't any activity on the chain. What we usually advise DeFi teams is build on a public chain first, work with various other DeFi protocols, explore synergies, tap on the liquidity of a public blockchain, and eventually once you reach a certain scale, you want to customize your own app chain to meet specific, custom requirements. That's where they can think of migrating towards an app chain.
Liquidity fragmentation is a big problem right now because it used to be just like Ethereum, and now there's like 100, literally like over 100 blockchains. So definitely a big issue. And actually, so I own some Solana, and one of my thesis is that if I'm using EVM, I have to choose like which of the 100 rollups am I gonna use. But for Solana, it's a Solana. You could argue it's like a little bit more centralized their approach, but in terms of usability, it's really good. So I think in the short term, maybe monolithic, cheap and fast blockchains may gain some market share. Over the long term, there's some good reasons for decentralization to exist. So I think EVM chains may gain back their market share and maybe eventually win, especially if there's regulatory issues, whatever. But in the short term, I think there's a good argument that liquidity fragmentation is pretty bad for the user experience.
Yeah, it's not only just the liquidity issue, but also a very poor user experience. Now, for my final question, I would like to pose a broad one to the panelists. What do you see as the next major driver of DeFi's growth? Like, where's the next DeFi flywheel? And yeah, what's your view on this? Maybe start from Jerry.
Okay, me first. Okay, so when we thinking about the flywheel spinning, probably I wanted to ask what is the end game we want to see, right? So we wanted to see in DeFi, if you are thinking of a similar to you go into the bank, the managers come to you and they show you the list of over 100 different products, and ranging from 1 day to 10 years, and you can choose what you like, right? If we want to achieve that stage, but what do we need today, right? So we need to think. We probably in like two angles, right? The first one is the timeline, right? So when you're thinking about from 1 day to 10 years with this timeline, right? So of course the first thing you need is a yield curve. You need to find a way to build the yield curve that you want, right? In DeFi, we normally take like an over collateralization to borrow fixed interest rate and the fixed term to maturity, right? Just similar to you have a, let's say, for example, you have an apartment. You want a mortgage. You want a mortgage for 10 years, 20 years of fixed rates. And then if you tokenize the certificate of your apartment, then put it on chain, what do you want? You want liquidity, right? And you want, if you're not selling it, you want liquidity. You want the mortgage again, right? So you need a fixed income curve to help you to price, right? So that this will increase the use cases and for the people on blockchain, right, using DeFi. So I think this is one thing, and you can think of that, and so that you can hedge your balance sheet, right? So if you have an asset, it's 1 year, and how do you lock your 1 year liability? Right? You need a fixed income protocol to help you to lock in this 1 year liability by borrowing 1 year at a fixed rate. Right? The other angle is the diversification. Right? You want to have a different kind of investment. So with the fixed income protocol coming up, so let's say, for example, if you have a fixed income token, give you like 5% return in 1 year. You can overlay that with a put option to create a dual token investment. You can overlay that with a perpetual protocol to give you the floating rate like investment. Or you can add like different variety of options, combination of synthetic options to give you a synthetic return, right? So this is for those who don't know how to trade derivatives, get what they want, the derivatives or the yield enhancement products. This is exactly the same as what you do today, working into the bank, talking to your account managers to get the investment products shown to you, right? So I think from that particular angle, if we achieve that, then the flywheel spinning, it just continues, it will never stop.
Let me just add one more to you, right? You have more than 2 decades of experience in TradFi world, and I know you've been launching more than 100 different products in the TradFi world. Do you see DeFi, like with its underlying technology, has the potential to be more innovative and, it just more innovative than the TradFi world?
Yes and no, I would say, right? Because of course, I think in DeFi world, the speed of like innovation is much faster than the traditional banking industry, and but there is a certain like a constraint that on blockchain it is not going to solve some of the regulatory concern, right? Which including recalls, for example, right? And then which including some of the operational hurdles that we may have, right? Maybe we'll see some like a fragile point, like in terms of when we do in the operation process, and that is we cannot switch off or switch back. This is a constraint we have, right? So I think combination of this it's a challenging task, but I believe with this innovation we will get there.
Right, Andy.
Yeah, for stablecoins, I think on a big scale, from the start, our team, we had this belief called stablecoin maximalism and monetary premium. So our founder actually touched upon this a few months ago during a keynote. But the idea of stablecoin maximalism is that with sufficient time and sufficient size, everything kind of converges to creating their own stablecoin. And monetary premium is that you don't actually expect returns from these stable coins. We have it because it's actually useful. So, like for example, Circle, we know that they're making a lot of they have sufficient treasuries, but we don't expect crazy yield or APRs from them, but we still hold it because it's useful. So the idea is that big players that we've seen, even this year, will converge to issuing their own stablecoin, and making it just very useful. And I guess on a smaller scale, Frax Finance's end game is that we believe that in the next few years there will be three major assets that kind of dominates the system, and we think one, it's obvious, US dollar, Ethereum, and then flat coins. So that's why we issue stable coins for each sectors, and to build sub protocols to kind of benefit that. And we have a lot of things coming out. Actually, we have Frax Chain, which is going to be a hybrid rollup with blockchain incentives. So it's going to be something that's pretty innovative. We have Frax ETH V2 coming out. Well, a part of it has been live, and we actually issued Frax V3 as of recent. We launched it, and we're in the RWAs now. So I think it's just expanding everything, and we believe we want to be the #1 stablecoin issuer for these three major assets going down the line, and I think that's the Frax vision as a whole right now.
You mentioned flat coin, like maybe not everyone here understand what's a flat coin. Could you elaborate more on that?
So flat coin is actually basically something that's pegged to the basket of goods. So right now, we're using the CPI basket of goods. So we have something called Frax Price Index, which is pegged to the CPI. And then we have governance tokens for each of those stable coins that we issue to kind of govern those tokens. Yeah.
Interesting, right?
Yep. So what we see as exciting on Arbitrum public chains is, we have been speaking with financial institutions in the space around tokenization of real world asset. Some of the assets they're thinking of is, VCC funds because of the clear regulatory framework. There are also teams thinking of, tokenization of like US Treasury bills, as well as government bonds, both US government as well as, emerging market bonds. One of the challenges of tokenization of real asset that we view is standardization. So there are teams that are tokenizing with ERC 1400. There are teams that are using 3643. And for teams that are flexible to use ERC 20, essentially it's a permissionless token. Whereas for financial institutions, there are some requirement on the AML or the CFD. And for that, they will have to use a different token standard. So getting these financial institutions to come together and agree on a set of token standard as well as like legal recourse is one area of innovation we're pushing towards, and we're also trying to actively contribute. And with folks like Term Structure, building out some of these frameworks as well as ways to hedge the stablecoins or RWA, that could be a good utility to actually increase adoption of institutional capital.
Yeah, so on flywheels and whether DeFi can out-innovate TradFi, I think definitely yes. So DeFi is just categorically better than TradFi. TradFi, you use a financial product, you don't know what's going on behind the scenes. DeFi, you can see everything on chain. Smart contracts is open source, you can audit yourself. You know you're not getting gypped or scammed. So I think that, and you can see that $55 billion today from $1 billion a few years ago. It's growing super fast. More and more people are using it from both the user side, and then also companies are starting to use it. And then there used to be an argument like, DeFi is super dangerous. TradFi you can get like 5% yield on your US dollars, but now with RWAs from like Frax and all these other providers, we have you have treasury yields on chain. The risk is super low. So there's almost, DeFi is not just out innovating TradFi, but it's like eating TradFi. So you have all the benefits of TradFi, but you also have permissionless finance, all these innovative new protocols and derivatives options. Like DeFi is making a lot of useful derivative products like options or futures more accessible for regular people and useful. So I think as more people try DeFi, it's growing and growing, and eventually, I think it will do extremely well. So I don't think it needs a special flywheel. It's just better, and as more people use it, it will take over finance.
Since we still have time, so let me add just one more question to the panelists. Is DeFi is really that good, and why is it like Binance is doing like 30, 40, 50 billions in notional, while DEXs are doing like 30, 40 million? Like, decentralized exchanges or ever overtake centralized exchanges, maybe from danger?
Yes. So actually, I love this question because the block has a chart of DEX versus SEX volume, and it's just up only. It's just up only. Like, it's amazing to see. So basically, like, there's more and more volume going to DeFi every day, and less volume is going to CeFi. And there's a lot of reasons for that. There's like, it's more fun to trade on chain. There's more like tokens. You can get yield. Like, there's protocols that actually reward you for using it, and it's more transparent. And also the user experience is getting a lot better. Like, it used to be you have to use like MetaMask, you have to like use like this crazy hardware wallets and stuff. Now you got like stuff like OKX wallet, which is, so it's like, it's an actual wallet, but it's like super easy to use. It interfaces with DeFi. And if you look at the Arbitrum stats, like on-chain stats, it's like that wallet is like the top user of gas for like Arbitrum, and I think also Optimism. So, as the user interface gets better, as more people discover DeFi, I think that dynamic of sexes currently dominating is going to go down and maybe even reverse. So, yeah.
Right.
So maybe I'll add on to that. I think agree on the user experience side. One thing that centralized exchange does really well is the fiat on-off ramp experience. They connect with local banking rails, enabling folks to get in and out of crypto in their local currencies. Whereas DeFi traditionally is predominated, I think over 90% is in US dollar markets. So for local economies or in emerging markets, they have to acquire these USD stablecoins before they start trading on DeFi. I think the second reason is also around slippage. So for most AMM-based DEXs, there are slippages if the pools aren't deep enough. So we have seen teams building, central limit order book DEXs. So hopefully that could solve some of the user experience and mimic a more centralized exchange-like experience.
Okay, so I guess without going too deep and technical, I touched upon this a bit earlier, but I think education again is the biggest pain point. I think similar to when we go to the beach, everyone can dunk their feet in and it's enjoyable, but you don't go swimming into it if you don't know how to swim. Similar to that, I think it's very easy and simple to kind of get your funds on centralized exchanges, and that's why we see a bunch of spot trading and everything. But in DeFi, it actually requires a lot of knowledge and a lot of studying and learning about everything in DeFi. It's not just one point of DeFi that and then you can go into it. So like similar, if you know Frax Finance, for example, it's a very complicated protocol, and the people who know it will take advantage of it. And I think when like Danger said, we see that more people from centralized exchanges to move into DeFi, and I think that's good. And that's great because that just proves that more people are being educated on DeFi. And so my take on it is that educational aspect is the biggest pain point right now.
Right, that's right. Like how many times you need to get rocked before you really get well educated in DeFi? Jerry.
Yeah, I like this question. It seems like they all answer the questions, which is what we are doing in terms of structure, right? So what we build is I think what we care about the user experience. So that's why we built our own DK rollup on Ethereum. So when you do it in the order book or in the auction process, you don't need to pay gas fee, right? So that's why we want to keep our users not to pay gas fee without any transaction closed with us, right? So and of course that other than that we have because of the DK rollup, we can make our DEX like a centralized exchange. You don't feel it like it is a DEX, right? So I think all these things that we are consider is about user experience. So I believe I think this is the gap. That's why we see centralized exchange has much more higher volume today, and then this is why we are trying to improve ourselves.
All right. So that concludes our session. Thank you everyone for coming to the panel, and please give a round of applause to the speakers and take a moment to follow them and support their work. Thank you.
Thank you.